We have, the Bank of America team here in the studios with us ahead of their conference, the big conference, which is going to be held in Delhi starting Monday. And I think this conference is being held after a gap of at least a few years. I think the first since COVID, if I'm not mistaken. Let me welcome in Arbind Maheswari, Head of India Equities at BofA Securities. Amish Shah is Head of India Research at BofA Securities as well. Gentlemen, great to have both of you here. Thank you very much for your time. And at the outset, congratulations for the conference, which is, of course, going to be kicking off. And Nigel, I think, is going to be there in Delhi with all of you guys.
Flying there on Monday morning, yep.
With all of you guys to talk about the conference and, of course, cover it. But let's just start with the market and where we are at. Amish, do you feel, especially because you have a fair bit of global coverage and you get a fair bit of feedback in terms of what's happening there, that we've turned in a very significant way after the last FOMC meeting? Because for the first time, the commentary, etc., from the Fed chair seemed very, very relaxed, very okay with what's happened and okay waiting, inflation can overshoot, etc. But is the road a little clearer from that perspective, from the global perspective, all the way till the end of the year? What's the sense?
So, the road, unfortunately, is not clear. I think there are...
At least till the end of the year? No.
So, I think markets are likely to be volatile if you're a near-term investor.
Okay.
Till the time there is clarity on global factors. And there are plenty of them, right? One doesn't... while there was a pause this time, there is a potential that inflation in US can reaccelerate. If that happens, you are again, the rate hikes are back in discussion. One doesn't know what's going to happen to the fiscal policy in the US. There is geopolitics going on. Connected to that is a crude related issue. So I think in the near term, given that there are global factors where there is volatility, markets will be volatile as well. But if you're a long-term investor, we definitely are bullish. We think that this is definitely a buy on dips market. And there are several reasons for that. But primarily, if you look at the earnings growth in India, they've continued to hold well, even including in the second quarter results that we are in. Valuations have now become reasonable. There is 38% of Nifty market cap, which is still trading below long-term averages. So there are plenty of pockets of opportunities to find. So in general, as far as large caps are concerned, we are bullish. We would stay away from mid and small caps at this point in time.
Okay, stay away from mid and small caps. And for the longer term, of course, buy on dips continues. That's a classic playbook that has worked, right, for the last 2 decades or so. Arbind, thanks for joining us on the show as well. I wanted to understand from you, how is the tactical positioning right now of India versus other emerging markets and also versus China?
Sure, and excited to be here. Thank you. Excited about our conference. It's a big event after post-COVID. It's the first conference that we are having, which is physical on the ground. Look, I think coming into this year, if we take a step back, there was 2 years of extremely strong performance from India, or outperformance from India versus emerging markets and China. And the hope was that there will be some mean reversion trade in there. And that hope led to the first quarter being quite volatile for India. We saw outflows from foreigners up to $5 billion. And in the same period, China actually incidentally saw inflows of $25 billion. But that didn't quite last very long. I think that mean reversion hope faded away fairly quickly. And then second quarter and third quarter, we bounced back really strongly. There was massive inflows into India, $22 billion from foreigners. And then China started to see outflows, especially August and September have been, we've seen a chunk of outflows from there. So in terms of positioning, I would say India still gets favored over the other emerging market basket. Emerging markets as a product has seen outflows in the last couple of months. But if you dig a little bit deeper, what is happening is the EEM, which is the ETF tracker for emerging markets, which includes China, that has seen outflows. But the emerging market ETF, which is ex-China, EMXC, is seeing inflows. So there is definitely favorites being played, where India, in terms of its positioning relative to other emerging markets, is seeing more inflows. And we can see it in the flow. We can see it every day on our pads. I think that's the story we are, across Asia. When we look at the overall flow, that's the story that is building up.
Well, good to hear that. And good morning, gentlemen. Welcome to the studio. Looking forward to catching up with you all at the conference in Delhi on Monday. Amish, you made a point about earnings, right? Earlier, we were a little bit worried about maybe the street is too optimistic on the earnings outlook from here. Mid-teens, maybe there's a downside risk. But from the earnings that have come up, do you think that there is a possibility that maybe we could see a bit of an upward revision to earnings? And with that sort of a backdrop, what about the banking names? Because earnings are good there, the stocks are not performing.
Absolutely. So financials look on whichever way you cut it, it would come up as the best risk-reward large cap sector at this point in time. Whether you call it positioning, whether there are some concerns that the banking sector earnings have peaked, because loan growth is going to slow down. There is competition for deposits. NIMs will compress. All of that said, we think that the sector still has an opportunity to give you at least mid-teens growth. Some stocks would probably give high teens growth. And for that, the sector is really attractively priced. So the part of that is also it getting clubbed with the US financials or global financials. And for them, higher rates is an impact on their investment books. So maybe Indian banks are getting dragged down along with the global banks. But definitely a space that we would be very bullish on.
And earnings overall has been better than expected?
Absolutely, it has been. It was better in the first quarter. Second quarter again. One could argue that large part of the earnings beats in the second quarter is driven by margin expansion, which may not sustain as we go along. So at this point in time, Nigel, we are not in the camp of overall nifty earnings getting upgraded. But look at it like this: that we started the year expecting 19% earnings growth for nifty companies for F24. We are already at 16. And the consensus is at 16. We are at 15. So I think broadly the markets have now settled down to where the realistic earnings are. And then if you look ahead in terms of the trends that we've seen for the festive season, all very encouraging so far. So that gives you an outlook of the third quarter earnings continuing to support as well.
I'm doing a piece later today on the editors roundtable looking at earnings. So I'm looking at the nifty, the top 200 companies and what second quarter earnings have done for full year estimates, FY24. And then I think we should look at FY25 for now in terms of earnings. But it doesn't feel like it's been a very buoyant earnings season. I mean, that's just it's just, okay, it's meeting expectations. There have been a few, clearly Reliance, Bajaj, Polycab, a few others. But anyway, we'll look at the numbers as they come in. Arbind, you mentioned EEM ETF ex-China. Is that a new product or has it been around?
It has been around. So EEM is the one which includes China.
Correct.
EMXC is the one which excludes China.
So we should now, the category is Asia Pac, ex-Japan, ex-China.
I would take it one level higher. I would say now for the first time after many years, we are actually seeing allocators of capital. These are foreign allocators who put money. They are looking for India-only mandates, which is standalone India, not including of Asia, including of China.
As we know, so about 96% of the money that we get, foreign money that we get, comes through these GEM funds, right? Only 4% comes through India dedicated vehicles, etc.
Correct.
Is that changing in some? Because we've been waiting for the last 1.5 to 2 years that will happen. Is it happening? Is that?
I think the groundwork is being laid for that. So, which is what I mentioned when allocators are looking for India-only mandates. I think in the because the story started to play out, especially in the last 2 years or so, the India story is really looking like an idea that the time has come for this idea now. So I think it is a long runway, and which is what I think makes us very bullish, makes investors very bullish, that it doesn't seem like a 1 year, 2 year story anymore. People are willing to take a bet and 5 years, 10 years out that this is a story in Asia that is going to emerge as, the compounder story which always gets associated with India. The next 10 years, it looks like a clean runway. It is our battle to lose. And it doesn't feel like it's going to revert anytime soon.
Okay, that's a very ambitious statement. The next 10 years looks like a clean runway. But I take your point. I mean, there are all the ingredients in place. Let's talk about sectors, right? Because that's what matters to our viewers the most. Amish, tell us which are the 1 or 2 sectors that you're most bullish on over the next 12 to 18 months?
Has to be domestic cyclicals. We've been bullish on that space for a while. We will continue to be so. That includes financials, industrials, and autos, primarily. Look, very quickly, if you just think about it, most of these sectors have very long cycles. Industrials, for example, either you are in a good cycle for 10 years or you're in a bad cycle for 10 years. We are currently in the third year of a 10-year cycle. So there's a long runway for growth. And what we've also seen is that when the cycle turns, this is a sector where you have a compounding of earnings because your margins double, working capital halves, you have your ROEs triple, and as a result of all of this, your valuation continues to expand. So are we, I know that industrial sector has already given very good returns, but, and then we often keep getting this question that are we done? I definitely don't think so. So I think this is going to be a long runway. There'll be a series of earnings upgrades, and as a result, valuations will continue.
Autos or industrial as a space? This 10-year cycle that you're talking about.
Industrials for sure, 10-year cycle. Autos is a sector which has mini cycles. It doesn't go for that long. Financials, I would say that the wholesale side of the loan growth, tags along with the industrial cycle. The retail growth is obviously on its own.
But in industrials, right? I mean, if you look at the biggest player there, L&T, for example, it's already been a 50% run in 2023. So one would feel that perhaps the best of the price move is behind them. That's not a good way to look at it? That's not the right way to look at it?
Again, I'm not getting to that stock.
Sure,
but if I look at it on a sector overall, think of it like this, that during the down cycle, these are sectors that probably give you single-digit earnings growth. During the up cycle, these are sectors that will probably give you 20 to 30% earnings growth. ROEs, similarly, during the down cycle is single digit, during the up cycle is in 30s, right? So as the earnings growth and ROE continues to catch up, valuations will also continue to catch up. And therefore, Sonia, yes, I agree that despite the run up, there's a lot of juice in the sector going ahead.
Okay, all right, gentlemen. We look forward to meeting you all. I'll be there in Delhi on Monday, and wishing you all the best for the conference. Looking forward to get more
all
insights.
the best.
Thank you.
Very welcome.
All the best,
we look
guys.
forward. Thank you.